Global Payments, GPN, is a stock that should have been a surefire play in the world of fintech. So how exactly did 5 of the most trusted analysts manage to botch their calls so badly? Their recommendations, laughably bullish at best, delusional at worst, led their followers right off a cliff. How do you miss the glaring red flags of underperforming acquisitions and their associated debt, stagnating growth, and an increasingly competitive landscape? Well, today, we're dragging these analysts into our Incompetence Court to answer for their crimes against logic and common sense. But before we take the scalpel to their clueless forecasts, let's dig into the deeper problem. What happens when investors blindly trust the experts, ignoring the fundamentals of a business? How do we, as smart investors, prevent being led astray by the so-called pros? In today's lesson, we'll give some tips on how to cut through the noise, evaluate a company beyond the hype, and avoid being a victim of analyst incompetence. So buckle up, because after this, you'll never look at an analyst recommendation the same way again. And if you're ready to take control of your financial future and explore a new income opportunity, consider starting your own YouTube channel. With Tube Magic by Matt Parr, you'll learn how to harness AI tools to efficiently create, grow, and monetize your channel, no matter your experience level. Matt's course provides a clear roadmap to turn your channel into a successful venture, helping you build a profitable side hustle while mastering YouTube's potential. Ready to make your mark? Click the link in the description to get started with Tube Magic today. In 2021, Global Payments, GPN, reached an all-time high of $213.52 as analysts praised its dominance in the fintech space and future growth prospects. But today, the stock languishes in the low hundreds, a shocking collapse around 50%. So, how did we get here? Meet 5 analysts who, even as the red flags piled up, kept shouting buy, or even worse, neutral, which is Wall Street for I'd rather drink instead of working and making a definitive call, while GPN's fundamentals started to crumble. Order in the Incompetence Court. Your Honor, I call James Faucette of Morgan Stanley to the stand. As you can see, James began covering this stock in 2020 with a series of bipolar buy and neutral call switches that were coupled with price targets that nearly matched the regression line of the stock's price movements. In plain English, that means that James was going for the average of the stock's price fluctuations. Neutral, average, can you say clinging for dear life to safety? But it gets better. After the peak, James decided to overbid significantly at 219, while the stock was hovering around 165, but strangely enough, held on to his neutral recommendation. He then continued to overbid calling neutral until his most recent bid in the trenches, where he is bidding 164 in the trenches with an overweight call. So he calls neutral using regression line bids, clearly playing it safe as the stock was climbing, only to overbid the price as it tanked while continuing to call neutral to cover his ass, and then turned around and overbid with a buy call in the trenches. You can't make this up, guys. This is crazy. And even crazier is that let's say he is right now and the stock is a value where it is. Who the hell would trust this guy with that track record? James, buddy, you screwed yourself. Instead of drinking margaritas in the sun, you should be crunching numbers and making accurate estimates like they pay you to do. Guilty as charged and sentenced to a life of unpaid manual number crunching. Our next culprit, James Friedman of Susquehanna, was way more incompetent on GPN. This James began his coverage in April of 2019 with a 130 underbid. They say your intuition is always right, but James unfortunately only listened to his intuition on this first call, because as you can see, he began to overbid the stock immediately after that with a series of buy calls and overbids that he holds to this day. You started so perfectly, James. Why did you drink the Kool-Aid? You could have knocked this one out of the park. We can't say that much about John Davis of Raymond James. John is facing charges of gross incompetence. John began his coverage of GPN in May of 2017 and didn't waste any time. He ran for his closet, got his pom-poms out, and began cheering away. This actually was a good way to start, because as we can see, outperform at 102 was actually a solid call, as the stock was about to go on a huge bull run. But things got a little funny when John decided to make a market perform, i.e. neutral call, of 145 in June of 2019. This was not only bipolar and a clear cling to safety, but also just outright incompetent, because his next move was a slight change in sentiment to outperform right before the first peak. So he told people to hold off lightly in the first quadrant of the bull run only to tell them to start jumping in right before the peak. And even worse, he tells them to jump in head first right at the peak in January 2020 with a 217 target when the stock was about to crash. What the hell was this guy thinking? The timing was way off, and after this, he lowered his estimates, holding on to his outperform call, essentially playing chase with the stock. The stock crashed after this, and way too many investors lost way too much money. The jury is still out on GPN. It can go either way from here, and he can very well end up being right on the current run, because he holds on to outperform to this day. Either way, he said, hold in the first quadrant of the run, only to turn around and scream buy on the cliff. Guilty as charged and sentenced to probation for 1 year. Our next defendant today, Ashwin Shirvaikar of Citi, definitely loves this stock. He began covering this stock in October of 2015 and quickly grabbed his pom-poms and started cheering. Problem is that he never stopped cheering. Before the first peak, Ashwin clung to the stock trading price, adding $10 or so to the market value. But as the stock began to peak, his price targets became more aggressive. Way to cheer for the stock you love, Ashwin. But unfortunately for him, the stock took a nosedive after that aggressive bid. But it gets even better. Right after the second and last peak for this stock, Ashwin decided to triple down with an even more aggressive price target of 247, when the stock was literally taking a nosedive and sitting around 170 and headed much lower. He continued to play chase with his estimates still overbidding aggressively by more or less the same margin of idiocy, and continues to hold his ridiculous buy call to this day. Guilty as charged. Our next defendant, Darren Peller of Wolf, is being charged with copying John Davis's homework and gross incompetence. Darren began covering the stock in May of 2016 with a series of neutral calls that quickly changed into buy sentiment. He held on to his buy sentiment to this day. And to be honest, if he had simply played chase between the peaks and went all in like his co-defendant John, after the peak, his chart would suspiciously mimic that of John's to the point where a baby could recognize his copying. He avoided this because he clearly did copy John's homework before the peak and didn't want to be that obvious. To add insult to injury, he clearly lowered price targets playing chase with the stock price after the peaks without switching his recommendation to sell, and this lost way too many people way too much money. Guilty as charged of copying and incompetence and sentenced to a life of manual number crunching at your nearest investment bank. Disclaimer: incompetent capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. Now that we've thoroughly exposed the incompetence of these so-called experts, let's shift gears and dive into the company itself. How did a fintech giant like Global Payments, once heralded as a leader in its space, spiral into this mess? We'll peel back the layers and take a closer look at the underperforming acquisitions, mounting debt, and increased competition that contributed to its downfall. Understanding the company's history, strategy, and missteps is key to grasping how these analysts got it so wrong and how investors can learn from these critical mistakes. Global Payments, GPN, began as a strong contender in the financial technology space, specializing in payment processing for merchants, software providers, and financial institutions. Established in 2000, the company quickly became a key player in the digital payments revolution, capitalizing on the shift to cashless transactions. By 2019, GPN had a global presence, lucrative partnerships, and was seen as a fintech juggernaut. Analysts hailed the stock as a surefire winner in the rapidly expanding industry. However, behind the bullish outlook, cracks in GPN's foundation were already visible. A key issue for GPN was its aggressive acquisition strategy. The company pursued growth through major purchases, including Heartland Payment Systems in 2016 and Total System Services, TSYS, in 2019. The TSYS acquisition An all-stock deal valued at $21.5 billion was meant to cement GPN's dominance by combining its merchant acquiring expertise with TSYS's consumer payment solutions. However, it introduced significant operational challenges. The integration of TSYS was far more difficult than anticipated, leading to inefficiencies and rising costs. Compounding this, TSYS card issuer customers held significant leverage during contract renewals, often negotiating pricing concessions that further limited the company's growth. This pressure squeezed profitability and stunted the anticipated revenue boost from the acquisition. Financially, the warning signs were unmistakable. Revenue growth slowed as GPN faced mounting operational costs from its acquisitions, particularly the unfulfilled synergies with TSYS. Margins were compressed, and the company's ability to generate free cash flow weakened, making it harder to manage its pre-existing debt load. Meanwhile, newer and more nimble competitors like Square and PayPal were capturing market share with innovative products and platforms. GPN, bogged down by legacy systems and slow to innovate, found itself struggling to maintain its competitive edge. Despite the clear red flags, slowing growth, operational inefficiencies, and increasing competition, analysts continued to issue bullish recommendations. They overlooked critical risks, such as the leverage TSYS's clients had over pricing and the weakening synergies from the acquisitions. As a result, investors who followed these overly optimistic calls were blindsided when the stock experienced a sharp nosedive, losing over 50% of its value from its peak. While the jury is still out on GPN's future and earnings remain robust, it's crucial to recognize that these overly optimistic calls during the downturn caused significant financial losses for many. Analysts who continue to be bullish might still be correct, but their previous recommendations during the stock's crash had serious consequences for investors. If you want to be a competent investor, you need to understand that mergers and acquisitions can be a double-edged sword. While they may initially appear as a path to significant growth, they often introduce complexities that can undermine the intended benefits. It's crucial to remember that growth from acquisitions is not the same as organic growth. Integration challenges, such as those experienced by Global Payments with their acquisitions of TSYS and Heartland Payment Systems, can lead to operational inefficiencies and unforeseen risks. Before jumping on the bandwagon of a company pursuing aggressive acquisition strategies, carefully assess how well these deals integrate and whether they truly contribute to long-term value. Revenue growth is a key indicator of a company's health, particularly for stocks with high price-to-earnings (PE) ratios. In high PE stocks, investors are often betting on aggressive future growth, so any signs of stagnation or slowdown in revenue can be a huge red flag. For instance, Global Payments revenue growth slowed amidst rising operational costs and increased competition, signaling trouble despite initial bullish recommendations. Investors should pay close attention to revenue trends and ensure that a company's growth trajectory aligns with its market valuation. Ignoring these signs can lead to significant financial losses when expectations don't match reality. In closing, the story of Global Payments serves as a potent reminder of the importance of critical thinking and due diligence in investing. While analysts' recommendations can sometimes provide valuable insights, they are not infallible and should be scrutinized alongside sound fundamental analysis. Mergers and acquisitions, while potentially lucrative, come with their own set of risks and should be evaluated for their true impact on long-term growth. Likewise, monitoring revenue growth, especially in high PE stocks, is crucial for understanding a company's financial health. By remaining vigilant and questioning the underlying assumptions of market predictions, investors can better navigate the complexities of the financial landscape and avoid costly pitfalls. Check out this video for a lesson on the basics of fundamental versus technical analysis.